You're listening to the RE Social Podcast with your hosts, Andrew and Vince from OnV Invest. For more information, go to onvinvest.com.
What's up, guys? Welcome to another episode of RE Social. Today we have a super special guest, Mr. Brian Burke. Welcome to the show, Brian.
Thanks for having me here.
Yeah, if you guys don't know who he is, he actually wrote this book called The Hands-Off Investor. And if you want to get nerdy about like how syndications are done, or if you want to invest passively or actively, this is the book to read. This book is so good. I'm like, dude, you have to read this book. It actually taught me so much about what I don't want to do too. Like, because I'm a nerd, I'm an engineer, and I understand all the waterfalls. And I'm just like, this is not something you want to tell your investors. This is how we spend it. So, it's just a great book. Brian, do you have anything to say about that book to people who haven't read it?
Well, I think the most important message for anyone that hasn't read the book is if you're planning to invest in a passive real estate syndication, please read this before you do so. Because the whole goal behind this book was to prevent or help prevent people from making mistakes and making a bad decision and getting into the wrong investment. Now, to flip the table, if you're planning on becoming a real estate syndication sponsor and you're planning to raise money from other investors, then you should also read this book, because it's going to basically tell you everything that your investors are going to be asking you, so you can be prepared with those answers. And so it really is appealing to both sides of the passive real estate transaction.
Yeah, Brian and I were just talking before the show, telling there's like two different types of people. One wants to get into the weeds, and one is like more high level. So for me, in my business, Drew just joined. He's my business partner. He's kind of like the operations guru in the business. He does all of this stuff, right? And he doesn't like all of the number stuff I do. And I'm more on the higher level. But even he has read this book, and he was like, bro, this is some next level stuff. So I really enjoyed reading the book. And, Drew, did you read this book, right? The Hands-Off Investor?
Yeah, it was a couple years into our journey. So some of it was kind of reiterating things that I kind of learned the hard way. But there was a lot of things that, it cast a lot of light and some shadows in terms of kind of just what the perspective is of people who just don't know. So that was the biggest takeaway for me.
Funny you say that, Drew, because everything that's in that book, I learned the hard way. So don't feel bad if you learned it the hard way. I did that.
Yeah, I'm working on it, man. I'm working on just trying to read more and interview guys like yourself, and just, hopefully shave some years off of that learning curve. Because I've kind of done the same thing on a couple of things. And I look back, I'm like, man, if I just worked for free for a year or read more or whatever, man, I just want to win like that. But everything in its time, So let's get back to your journey though. How'd you learn things the hard way? How'd you get started?
Well, I got this PhD in the School of Hard Knocks, is the way I like to put it. I started investing in real estate not long after high school. I was 20 years old, had no money, was working in a grocery store for $13 an hour. And I read a book that said that you can invest in real estate without having any money. And I thought, well, that's great, because that's me. I don't have any money. So I bought my first house by having the seller carry back the down payment, and had a finance company that financed the rest of the purchase. And that was my first rental house. And I didn't even have my own house. I was renting an apartment, but now I had a rental, and that was my very first experience in real estate investing. And after that, I decided that, it would be difficult to get a lot of rental properties without having any money, or even having to ask other people to carry down payments. So maybe the best plan for me was to flip houses. So I could buy it, fix it up, and resell it and make a profit. So I started doing that. And since then, I've done it about 740 times. So house flipping became a primary business for me, but then grew into multifamily about 20 years ago. more out of necessity because I just needed to scale. And about 15 years ago, really started scaling the multifamily business because we were starting to raise quite a bit of money and needed something that was sustainable and scalable that would be an investment model that would work over the long haul, and kind of never looked back.
So Brian, you started off with flipping houses?
Sure did. Yep. One house at a time.
So you and Tal Yarber didn't learn much from just flipping houses for a long time. So how did you transition? Because it's a totally different game, right? So you guys flip houses, you're making a lot of money, you're paying 50-60% taxes in California on the high end. And then you figured out, how did you figure out like, well, actually, this is not going to make me wealthy?
Well, I figured that out a long time ago. Is actually 20 years ago this year when I made my first multifamily investment. And it was really because I had a couple of rental houses that I'd collected through my flipping, and they'd gone up in value. And I felt like I could do better if I sold the 2 rental houses and bought some apartments. So I sold the 2 rental houses. I did a 1031 exchange and bought a 16-unit apartment building. And that was my first entry into multifamily. I felt like, it made sense to me to have multiple units in one location. It seemed more manageable to have the sites contained in one space instead of, multiple rental houses scattered all over the place. So that really was the, my initial entry into the multifamily game. But I really got pushed more heavily into it after all the foreclosures in 08, 09, back during that period. I was flipping about 120 houses a year. We'd collected a pretty sizable rental portfolio. By this point, we had about 120 rental houses in the San Francisco Bay Area that we had acquired at the bottom of the market. And then, all the houses that we were buying in foreclosure, and we were raising a lot of money to buy them. And it was like, well, these foreclosures are going to be gone in 3 or 4 or 5 years. And then what are we going to do? It's like the nice thing about multifamily, so single family, a house could be 200,000, it could be 500,000. But in multifamily, it could be 2 million or it could be 100 million. So, we can scale a lot more in the multifamily side than we could with the single family side. So it just made a ton of sense to make the shift and focus our efforts more on larger multifamily. And like I said, once we did that, we really never looked back.
So you had doing some flipping, and then you had some single family rentals. How many did you have at that point? Like a few, or?
Yeah, initially, early on, I probably had, 20 or 30, maybe 40 units, kind of early on. And in fact, most of those I actually still have. I never really was much of a seller, but when we really started getting more heavily into multifamily and, call it 2010 or 11, we had about 100, I guess I had about 150 rental houses by that point. And
so were you raising capital at that point already, Brian, for those JV deals?
Oh yeah, I raised capital for everything. Because remember, I got started in real estate. I had no money, so even when I was flipping houses, I was raising money to flip houses. I mean, the very first fund I ever raised was like 22 years ago or something. When I left my full-time job, I was working for a police department, and I just put in my 2 weeks notice, left the department, and I just told everybody, like, hey, I rented out the room of the community center. I'm going to talk about what I'm doing in real estate. Everybody should come. And they did. Like, everybody I worked with came. And I told them like how I was flipping houses and doing all this other stuff. And I said, look, if you guys will invest with me, I'll split the profits with you. So I'll take minimum $5,000 investment. And literally, I created my first fund. I had a blind pool fund that I had full discretionary control over the capital. I had $500,000 of investments that came from all my ex-coworkers, all of who carry guns. And immediately I was put in the private equity business, and my life was at stake because all my lenders or all my investors, knew how to hide the body if anything went wrong. So, I made sure I never lost anyone's money. And I went out and started flipping houses using that capital. And then it just grew organically from there. It started out with 500,000, a few years later, we had a couple million. When the, after the market collapse, we were raising tens of millions. And, now we're raising, hundreds of millions. So it just grows over time.
So the 5K minimum, I'm assuming that it worked out because you had a personal connection with these guys, so you can just, it's friends and family, so it's like a 506B-ish kind of deal.
That's right. It's 506B. You can have up to 35 non-accredited investors, and all of which I had a prior personal relationship with, because they all knew me for years. I worked there for 14 years, so I knew all these people for, over a decade. And, you can raise money like that. And so that's how that offering was. It was really a simple offering. And, the $5,000 minimum was designed because, these aren't rich people. I mean, these are, people that are working for a $75,000 a year salary. And, that's, $5,000 meant a lot to them. And some people, I had a couple of people that gave me their kids' college savings. Here's $5,000 that I've saved up for my kids' college. And they invested with me for so long that finally they had to withdraw the money because their kids were going to college, and it paid for their whole kids' college. So, that was, that's kind of how it started out. Of course, then, they tell friends who tell friends who tell friends. And, here we are a couple decades later, and, raising money isn't our biggest problem anymore.
How many deals did you have under your belt, Brian, before you had the confidence to be like, hey, give me $500,000, guys. I know what I'm doing.
Yeah, I had about a dozen and a half or two dozen, I think about 2 dozen deals that I had done.
That's pretty good.
Yeah. It was a couple dozen. And, I had good success with all of those. And, and those were done just, bootstrapping every which way. It's like, I would apply for every credit card offer that came in the mail. And then I remember I got a whole stack of credit cards that I got. I took them down to the bank. I handed them all to the teller and said, cash advance all these to the maximum limit. And the teller looked at me like I was insane. They're like, are you crazy? And I'm like, just do it. So they did. I walked out of there with a cashier's check. And, that's how I got, my second flip, was doing that. And then I went to Wells Fargo Bank. I'm like, would you guys give me a signature line of credit? And they're like, we can give you one for $25,000. So I got a $25,000 signature line of credit that I could literally just write a check on and get, 25 grand. And I used that to get the third house. And, it was just that kind of stuff. It was like anything and everything I could do to produce some success that I could show the investors, that I actually knew what I was doing and could, actually make money. Because that's the important thing. People try to raise money straight away. It's like, I've never done any real estate deal. I'm going to go tell people, give me money. It's like, that's not going to happen. You got to show them like, look, this is what I've done. This is what happened. This is how much I made. I'm going to do it again. And if I use your money, I'll split the profits with you. Then people get interested.
So you were splitting it 50-50?
Yeah, that was our first fund was a 50-50 split. So, it's like they put up all the cash, even if it was in $5,000 increments, it's of course split pro rata. So the investors would get half, I would get half. There was no preferred return. There was, no waterfall structure. It was just a very simple, we'll flip a house. If I make 50 grand, I get 25 for doing all the work. You guys get 25,000 for putting up the cash, and that gets split out pro rata amongst all the investors. Simple as can be.
You think over time that the investor started demanding more? Is that why we have more like a 70-30 kind of split with the 8 pref, and that's why we kind of do that and then take some fees and stuff on the back end?
I never took fees. And so what I went the other direction, and then it got to the point where I was getting 70% and the investors were getting 30% because, the returns were so high that because I was able to lever all those deals, because I finally had built a private money relationship where I could get private money loans on the houses I was buying. So it's like, I had $500,000. I could go buy, let's say, 2 houses for $250 each. And then I could go to the private money lender and get almost 100% of my purchase price from the private money lender because I was buying the houses at 60, 70% of value. And I would get the whole 500 back, which I could then circle back and buy more houses with. And so because we could do a lot with a little, the returns were astronomically high. And so there was a point when finally, I think the second or third fund, the profits were 70-30, with 70 to us and 30 to the investors. And, now I've got it in the latest flip fund. I actually still have a flip fund, but I haven't took investments in it for years. But it's just it's a 55 split to me, 45 to the investors, and I haven't changed it in a decade.
And then you don't have any a management fee or a acquisition fee in any of those things, I assume? Or
I do now. In the flip fund, I have a 2% acquisition, 2% disposition. But that came about, probably about 15 years ago. Finally, when I first was started in this business, I didn't know you could take a fee. I'm like, I'll split the profits. That was the deal. And then when we got to the third or fourth fund, it's like, you can take fees.
mm-hmm.
Oh, okay. I should do that then. So then started putting fees in there. Of course, now, our deal structures have changed a lot. In the multifamily side, it doesn't look anything like that. That kind of a deal structure works great on a house flipping fund, but for a fund that owns real estate over a longer period of time, that kind of a deal structure just isn't really feasible. So, now our deal structure is much more institutionalized with, 2% acquisition fees, no disposition fees, 70-30 splits with 70% going to the investor after an 8% preferred return, with, waterfall hurdles at, 12, and I think ours are at 12 and 14 or 12 and 15%, where our participation increases once we reach those targets. So, now it looks quite a bit different than it did back in the day.
Mm-hmm. Very interesting. I have more like a philosophical question. Drew and I have been kind of dealing with this. When you talk to investors, right? We want to help as many people, but also obviously we want to raise capital and go bigger too. So in the being raised I don't know, close to $1 million, maybe less, something like that. And we have maybe $8 million of assets under management, very small. But when we talk to people, a lot of people have very apprehension. They're like, why would we, give away 50% of the equity, So we come across these guys, and I'm trying to explain, you're not giving away 50%. You're only putting 15% down. I am giving you 35% because I'm paying the mortgage, right? So how do you explain it to the investors or partners and, kind of make it like a more win-win situation?
Well, what investors have to realize is the value proposition that the sponsor is bringing to the table, right? And so, we've got a lot of investors with us that are in the tech industry, because we're based in Northern California. So Silicon Valley is a couple hours drive from our office. We've got a lot of investors that work at some of the, household name tech places where they're working, 80 hours a week. And, they live in the Bay Area where investing in anything in their own backyard doesn't make any sense at all. So if they want to invest in real estate, they got to get on airplanes, they got to cross state lines, they got to go find property, they got to go get financing, they got to do all this stuff that they have zero time to accomplish. And that's the perfect investor avatar because, they recognize the value that we bring by doing all of that stuff. So all they have to do is sign a subscription agreement and contribute their wire, and then they get to participate in a real estate investment that they otherwise would never have had the ability to participate in. And that comes at a cost. And, it's certainly fair for someone to say, well, gee, why should I give you, 30% of the profits when I'm contributing all this money? And, it's, well, 70% of something is better than 100% of nothing. And you're not going to be able to invest in anything without my help because you don't have the time. So we're bringing connections, we have relationships, we're bringing the time and effort that we put in. We're bringing our personal balance sheets to the table to get financing. We're bringing the purchasing power of multiple investors who will contribute a large amount of capital to buy a property larger than what you'd be able to acquire on your own, which means that you get that benefit of the economy of scale, which kind of almost more than makes up for, the slice I'm getting. And, the investors will see the value proposition. If they don't see that value proposition, you're just talking to the wrong audience. And it's time to find somebody who understands that value proposition. And not everybody will. Some people are just like, hey, I've got all the ins I need in real estate. I got all my own connections. I got my own deal flow. I got all the time in the world to do all of this stuff. I don't need you. And yeah, they're probably right. They probably don't. And maybe they won't see that there's value that you're bringing to the table.
Yeah, man, that's really nice way to put it. The one of the conundrums, Drew and I have, I don't want to speak for Drew, but Drew's from Kansas and I'm from India, and we didn't come from a lot of money either, right? So we are very we want to help the people like lower middle class Americans, But the thing I see constantly is a lot of the people who don't have a lot of money also happen to also have very poor mindset. I'm not talking about money in their bank account, right? But they have this poor mindset, and it's harder for me to make them our investors. And once I start going to the higher level, they're like, oh yeah, 50 grand. Yeah, don't even call me again. Here's 50 grand. Bye. See you next year. Right. Those kind of deals. Right. My sister, my cousin, Drew's mom, it's very easy if you have the connection and if they have a little bit more money. Once you only make 50, 60, 70, $80,000 and you ask them for 50 grand, now they're like, hey, I could do this by myself. Yeah. Do you see this also, or is there a way out of this?
Yeah, well, the way out of it is that that's the wrong audience. These kinds of investments aren't really built for, the average American, so to speak. And, I made that work. My fund was full of cops. I mean, these weren't rich people, but I wasn't asking them for 50,000. I was asking them for 5. Now, a couple of them put in 100. Which that was a lot of money, right? These are the biggest investors I had, and that was a lot of money to them. But they also had a lot of confidence in me and also had success and didn't have that poor person's mindset. They were investors in other things. And that's how they got the 100 grand to give to me, is because they were successful in the stock market or maybe in real estate. And, they were doing that stuff on the side, and they understood, how to make money and what that value proposition was. The people who are just in it for the steady government paycheck are not going to understand what you're trying to tell them. And while it's noble that you want to say like, hey, we want to help the middle class person get out of middle class thinking, think bigger, do better for themselves. Some will, and most won't. And you're going to spend so much time on the most that won't, that you'll never even get to the some that will. And you'll find yourself pulling your hair out. And it's a noble cause, but it's not going to build wealth for you. If you want, I learned a long time ago that.
Have you thought about investing in real estate and taking advantage of all of those benefits without any of the work? That is something that OnV Invest not only provides, but has been providing since its inception. With friends and family, we have built an empire and a system of a wealth generating tool that is giving us and our friends and family that leverage in their life to create true wealth. Go to onvinvest.com for more to see if you qualify. And thanks for listening.
It's a noble cause, but it's not going to build wealth for you. If you want, I learned a long time ago that the most money isn't made by the person that does the best job or finds the best deals. The most money is made by the people who can raise the most money. because that allows you to be in the most have the most opportunity, right? You can buy the most real estate, you can participate in the most upside and all of that kind of stuff. And once I figured that out, it really changed my life, and our business began to skyrocket. And of course, those who raise the most money are usually the ones that do the best job, because the ones that do a crappy job raise money for a little while, and then they get figured out that they're not doing a good job, and then they can't raise any money ever again. So you have to do a good job, but really it comes down to those who raise the most money reap the highest reward.
That is that's a great piece of. I like how you have all these wise ways of answering questions, and I'm just out here like on drugs all the time, just going crazy. But if we have a lot of listeners who are young and they want to get in, and they are middle class. I know I keep going after the middle class because that's like my passion, whatever. But what advice would you give them if they are listening to this and they're like, bro, I only got 10 grand, I don't have 50 grand. Like, I'm not taking 10 grand if you only had 10 grand. Like, I don't care, right? Go find something else. But if they only had 10 grand, 20 grand, what would you tell them? Like, what should they do to kind of get started in this business?
Well, this business isn't about the investment itself. It's not about it. Your success really depends upon your return on investment, but your ability to generate your return on investment depends on your willingness to take risks. And so, I've heard so many times people in my life have said something like, wow, it's really cool what you guys are doing. You really deserve it because you've worked so hard. And it's like, no. Nothing that I have in my life, no tangible physical possession. I don't have any of that because I worked hard. I have it because I took massive risks that most people aren't willing to take or aren't capable of taking. That's how I got from there to here, because I was that person, the person you described with 10 grand. I had no grand. I mean, I literally, like, if I had $100 in my checking account, I was like, yeah, this is great. I'm on Easy Street this week. And to get from there to where we are now, it took taking massive risks. It took some luck, but it took also failure, and massive failure, and getting completely wiped out and feeling completely desperate about how am I going to get out of this situation. And then your brain figures out a way of how to get out of the situation, and then you begin to grow, and then you become more than you ever would have imagined. If you would have told me when I was 20 years old that 30 years from now, you can say that you've bought almost $1 billion worth of real estate, that you've done acquired over 750 properties, that you've had over 4,000 multifamily units, I would say you're absolutely nuts. None of what you've just said would describe me in any way. There's no path for me to get from where I am today to that path you just described. 100%. But all of that is true. And it all came because I took massive risks. And so, you got 10 grand. It's like, what are you going to do? Are you going to go out and, go use that money to, put it together with some other money you can find from friends and family or credit lines and buy a house, fix it up, resell it, make a profit? Now you got 20 grand that you can go and do the same thing again. And now you got 25, then you do it again. And now you got 30, 35, then you do it again. Then you got 75. And then, are you willing to do that? Because if you're not, you're going to have 10 grand, you're going to earn 3 or 4% on it if you're lucky.
Yeah, I think going back to that audience that you're referring to, that, we've been kind of focusing on the wrong audience, is a lot of that is that's the, I don't know if I say wall, I'm not quite sure the word I want to use, but that's usually one of the biggest factors in getting the no, is realizing that they're so risk averse that it doesn't matter how great the deal is. They just can't get their head around any amount of risk. Even when they've seen you doing it well for years. I've noticed there's just some people who you can't pull them out of that, and you just got to walk away. You got to move on, and just kind of touch on, in my opinion, how we've been able to grow as quickly as we have, which we're at a very, very low level compared to many of our amazing guests like yourself. But it's been 4 or 5 like really big, here we go, like that's changed my life personally, and I know Vince as well. And what's interesting is we take those calculated jumps, we've done the math, we know the risks, and sometimes you get punched in the eye, in our first deal we did. And I've noticed that anybody that we've interviewed has done the same, has just gone for it, went big, and put some money in the game, and sometimes lost, sometimes did. But what's interesting is it forces you to level up. It forces you to dig down deep and shine a light on the resourcefulness inside of you that's always been there. I think everybody's infinitely resourceful and can figure it out. I think what you've done is you've just pushed yourself over the cliff. You're like, all right, you got to figure out you got wings. That's how do you flap those now? Because it's do or die. And you made it work, because it literally was do or die. Would you agree?
100%. And that's really when you are at your best.
Yeah.
Is if it's not do or die, it's like, hey, if this works out, that's great. But if it doesn't, I've still got this steady paycheck job. I've still got my paid vacation. I still have a pension. So, but I'm going to see what happens. You're less likely to succeed than if this fails, I'm screwed. It's like failure is absolutely not an option. If you're in that position, you're much more apt to have massive success, because you're stuck. Tony Robbins said it, right? If you want to learn how to get off the island, you got to burn all the boats. And that's the theory behind it, right? You have to have no other means of escape other than success.
Yeah, that's great. Yeah. For me, I always try to take calculated risks, but like at the end of the day, like I'll have contingency plans, like a plan B, plan C, plan D. Oh shit, here it goes. My last plan, the plan Z, is always, I'll roll up my sleeves, I'll sacrifice sleep, I'll sacrifice social life, and I'll just grind until I figure it out. And we've had to do that a couple of times, early in our investments, as I think any investor has. And glad we did. It really kind of taught us some valuable lessons, but also gave us a lot of confidence, which is huge. That mental aspect, it gave us a lot of confidence, and it helped us to okay, we figured this out, let's do it again. And and coupled with that education you get from learning from being in it, it's just it's totally transcended us. And I mean, you're at a whole different level. So what's happening behind the scenes, in your first 5 years? Because we're on our what is this, Vince, our 4th or 5th year?
It's our 5th year.
5th year. So what's happening in your head? What would be your next move if you were us? 5 years in, got some good deals, everyone's making money, but cash flow's tight. What's your move?
Well, the first move is to take your experience over the last 5 years and document the crap out of it. You need to have all kinds of exhibits with color pictures and numbers to show this is what we bought this for. This is what, it was rented out for before, and this is what it's rented out for now, or this is what it was worth then, and this is what it's worth now, or this is what we sold it for, and this is how much we made. Here's some before and after pictures of what it looked like when we bought it and what it looked like after we did this. Yeah. You've got to, what you're doing is you're building a package to show to someone, so that if when you come to them and say, hey, we want to buy this $1 million building and we need to raise $350,000 to do it, and this is our plan, we're going to do X, Y, and Z to it and make it worth this much money and make this much profit. And oh, by the way, here's the last 5 years of efforts, and here's what we've done. Here's the other 10 deals that we did, and here's the result of those. We're just out to repeat that success. We want to know if you want to take the ride with us.
Yeah.
That's what you got to be doing, because right now the market's kind of a little crappy. If you can probably all notice, it's not really the greatest time to be out chasing real estate deals, but it soon will be. So this is the time to be building your war chest, right? Get everything set, get all your exhibits, your track record, your all your documents ready. And then that way and start building your audience, get people that you're going to talk to, so that when you get a deal, you've got 20 people that you can go to that already trust you, because you've kind of already gone through this initial conversation with them. Like, hey, when we find something, would you be interested in taking this ride with us? And here's all about what we've been doing over the last 5 years. Once you've got that ready to go, then you'll be ready to take advantage of the opportunities that the market's going to present here once things shake out.
Yeah, that's great advice. I love and a lot of your book was the same way. And it's some of my favorite books do what you just did very precisely, which is kind of like hit you over the head with stuff that you kind of know. You're like, yeah, I kind of know I need to do that. And you just don't. And then you read a book and you're like, oh yeah, just do that.
Yeah. Yeah, exactly. It's like so easy to procrastinate and say like, well, I really need to make a track record exhibit, but first I need to organize all the files in my Dropbox. Yeah. And it's like, no, you're just wasting time. Get out there and, make the exhibit, start documenting things, do all the math and document it. That's the most important thing you can do.
Just yesterday on a call, we had a good chat. It's like, man, I need to like follow up with all of our friends and family, like my mom, our friends, like, and just because everyone's making money. And I'm like, well, I need to be more active in like just getting testimonials, at least something for the page. Like, we get so caught up. Now, I've been very busy with the short-term rental side, so it's been a little bit distracting, but starting to get some breathing room. And I'm like, yeah, we need to I want to ramp up things. I want to, bring more people up, partner with more friends and family and go even bigger. And like Vince was kind of saying, it's like, it's kind of hard to get somebody to see what's happening and to see how great it is. If even on your website, you don't have like someone saying how great it is. It's I'm like, oh man, all the principles that I've used for building my initial business, which is a completely different thing, I'm not really applying for us, so I need to like double down on that. And now that I've got most of our short-term rental stuff mostly automated, I was a little bit late because someone kind of trashed ours. So literally the cleaners right now taking care of some stains. But yeah, still kind of work out the kinks in that, but you're so right, man. That social proof, just showing what you've done, being transparent is truly the best way. Is that something that you utilized early on, or?
I did. Yeah, absolutely. I mean, I created all kinds of like, full color, like charts of like all the houses. Like I'd have pictures of like every house we flipped. They could go like, I'm 5 pages in and all I see is pictures of houses. And it's like, that's kind of it's kind of dumb, right? It's pictures of houses. Yeah. So what? But they look like, okay, you bought, fixed up and resold every house in every picture that I'm looking at. I don't need to ask any more questions. You know what you're doing, obviously. Right. And so that's the point of it is, I always say that in order to raise money from someone, from outside investors, you have to be able to satisfy 3 trust circles, right? First one is they have to trust the real estate. If that's your business, or if it's selling widgets, they have to trust widgets, whatever it is, that they have to trust that that's the right place to put money. And so, we're in the real estate business, right? We raise money for real estate. So if somebody's like, oh, real estate, that's toxic, it's going nowhere, it's like catch a falling knife, or it's too risky, or it's too this or too that, great. See you later. I don't even need to spend any time talking to them about what we're doing and about real estate. Now there's people out there that do. They're like, oh, I'm going to have a webinar. I'm going to tell you how great real estate is and all that. If they don't already know how great real estate is by the time they get to me, that's the wrong audience for me. It's just not even an audience I'm going to spend any time on. The second thing they have to do is they have to trust you, right? And so now you're talking to someone's like, hey, I want to invest in real estate. Why do I want to invest in real estate with you? Well, this is where you're going to say, oh, look at all this stuff that we've done, or these properties that we bought and the results that we got. And, oh, here's some testimonials from our existing investors that have said good things about us. I mean, here's a testimonial from our title company that says that we sign documents quickly. I mean, whatever it is that you guys do, have everything, everything you can in there. And then, so you want to get them to trust you, right? And that's what this is all about. And then the third thing is they have to trust the deal that you're presenting to them. Well,
Yeah.
you have to satisfy 1 and 2 before you ever even put a deal in contract. If you get a deal in contract and you're like, okay, let's go get people to trust us, it's like, no, you're way too late. You need to have all of that lined up before you even get that deal in contract. Now you get the deal in contract, you only have one trust circle to close. And that's to go to those investors that already want to invest in real estate, already want to do it with you, and show them the deal that you're going to do. And they go like, this looks like a great deal. Sign me up. Because if you go like, hey, we want to show you this deal, and it's like, and let me tell you why real estate is so great. You get tax benefits, and it's like, oh my God, you don't have that much time. You got to close in 30 days.
Yeah, that's great. I love that. Wow. That's in the book. Yeah, because that sounds familiar.
It may or may not be in the book. I'm not sure.
It's been a couple of years, so I don't remember, but
that might be an extra one. That's a bonus chapter, I just for you for today.
Yeah, when someone's a master at what they do, when they can kind of like really concisely and like almost effortlessly like narrow it down in just a couple of things. In your case, 3 things. That's just awesome, man. I love that. Wow, I'm gonna re-listen to this podcast for sure.
We have to. We can't remember everything. But I want to go back to your story. So now you created the fund, and then you got the comps, and the quick thing about comps. We actually bought this garbage of a property in Bakersfield, and then both the tenants on either side, so it was a triplex. They were selling drugs and doing all kinds of stuff. You know what I did? I got someone who has open carry and parked the cop car in the front. They all disappeared the next week. That was like the easiest thing to do.
That's a good strategy.
Everybody else just disappeared. Like, you want to get shot? Just keep selling drugs.
Yeah, I've had my share of properties like that too. I mean, we even had one property that was so bad we had to hire the sheriff's department to have off-duty deputies. They had a team that did this, right? They'd come in off duty and they do nothing but patrol your property. And it cost us $5,000 a month or something. Like, it was crazy expensive. But all they did is they chased drug dealers around all day long. And we finally got a handle on it. And then I decided this isn't really how I like spending my time or money. I'm going to invest in nicer property. So now pretty much everything we buy now is Class A stuff. We kind of are out of the Class C and we're definitely out of the Class D business, but pretty much out of the Class C business and sticking more to like B+, A- type stuff. And but it's a progression though. You get there. I mean, you don't start out in this business buying Class A properties. I mean, you usually start out doing more difficult things, proving yourself, showing you can produce results. And if you can survive the chaos of those drug dealer properties, when you get into Class A, it's like easy sailing.
Yeah, we started off with Class D minus, and then we went into C, and now we only buy B+. Actually, the last one we bought was like an A. I mean, Drew's sitting in that house right now. So it's interesting. So I wanted to know, how did you go from that first fund? You raised like $500,000, and then what did you do? All of the stuff you were talking about, like the books and the portfolio card pictures to show that's how you were able to expand?
Sure did. Yep, I did all that stuff. Yeah, I created all kinds of stuff. I had slide decks, I had booklets. I used to, this is back in the day, I used to have them printed at like Kinko's and spiral bound. And nice. I'd have boxes of them that I'd carry around. Now everything's just email me a PDF, or whatever, websites and everything else. But yeah, I literally had spiral bound books with deal statistics and property addresses and all that kind of stuff. And even to this day, I still have a spreadsheet that we keep up to date that lists every property we bought, what we bought it for, what we sold it for, and and how it has a running count. So I can see, like, anytime I can log in there, I can see how many properties have I bought. Oh, 770. Great.
That's awesome.
Yeah, we should do that too, Joe. We have some on our website, but not as good. Ashley Kerr from the Bigger Pockets Rookie podcast.
Yeah. Yeah.
She's walking around with the spiral bound still. That's what she does.
You can see why.
Yes, it works. So what platform, like, how did you get in front of people? Like, are you doing meetups to get people to come to you? Or how is that happening? Or did you do online webinars and stuff?
Well, early on, I was like going to Chamber of Commerce meetings and like with REIA clubs and all that stuff. And, the REIA clubs actually produced a little bit of result, Chamber of Commerce type stuff, never, not even a single thing. But I'm like a fly on the wall kind of guy. I'm not really a social butterfly anyway. So I'd just go there and then I'd leave and be like, all right, I didn't talk to anybody. That did me no good. I'm not one of those master networkers. Those guys certainly will outpace me in a hot second. But I would just, I started going to REA Club meetings, and because I had some success, I was invited to REA clubs to come and talk and, give I'd have the whole meeting would be me talking about what we're doing or teaching a real estate concept. And all that was great. But what I found that worked better than anything was just being educational. When I signed up for a Bigger Pockets website membership, years ago, and just thought, I'm just going to answer people's questions. And people would ask a question like, oh, I'm stuck on this. This is my problem. What should I do? I would post an answer. And it was amazing. People would contact me like, oh my gosh, I saw what you wrote about that. That was brilliant. Do you take investors? and it was literally like, yeah, we do. And so that did a lot of it. And then, of course, by virtue of the posts I was making on Bigger Pockets, I got on the Bigger Pockets podcast. I was on episode number 3, not 503 that they're on now. I was on episode 3. Wow. And so, people would like reach out to me all the time, like, oh, I heard you on the Bigger Pockets podcast and interested in what you're doing. And then, of course, BP, agreed to publish my book. And so then the book brought in. So it's like the more education I put out, the more inbound leads we have. I literally do zero marketing. I do no outreach. I do no networking. I don't go to do anything. I'm asked to speak at conferences. I'm asked to be on podcasts. And I post once in a while on BP, and just people come here because they, hear that expertise and say like, I trust you, right? That second trust circle we talked about before. I trust you. I want to invest in you. I want to invest in real estate. That's why I was on Bigger Pockets to begin with. I read what you wrote. I liked it. I trust you. Now I want to invest with you. And then just tell me when you have a deal. And that's kind of how it works now.
Yeah,
it takes a while
because you're just bringing so much value though. And you were doing it for free, which is awesome. Mm-hmm. Which most poor people and poor thinking, like we're talking about, that would never occur to them to just like give value like that. And that's another Tony Robbins concept that I remember reading about, which is forget about the money, just give value, because the money comes like in almost equal balance. And so you're making other people wealthy by answering little questions. And then it just took you so far. That's amazing, man. I love that.
That's how it works.
Yeah. Yeah, that's part of how we've been able to raise a little bit recently, is like our podcast like this. Is we have friends who will be like, I literally had a friend call me. I was on the road, just like walking properties one day, and he calls me up, friend I've known for years. And he's like, hey man, I'm ready to go. I was like, oh, okay, great. Well, this is how it works. I'm ready. Like,
yeah,
okay.
That's right. That's how it works.
So
that's
we had
how it
a
works.
Dinner. Yeah. Because he understood, he could hear Vince talk. He could hear me talk. He's like, these guys know what they're doing. I don't know what I'm doing. He kind of got it. And let's be honest, he probably read Rich Dad, Poor Dad. I find that's like step number 1 for at least in my circle. We don't swim in a lot of like sophisticated investor circles. So that usually is like the big one that gets them like, oh, that's what Vince and Drew are doing. And then it's a matter of like listening and getting, some questions. And they're like, okay. So
the biggest thing to keep in mind is it just takes time. And even, and I know it's terrible, days are 24 hours long, and it seems like forever when they add one day after the other, but it just takes time. That's all.
Yep. You're right. Is there anything that you would do differently? So it's just interesting. I want to hear your answer. I'm excited about this. I know we got a couple minutes, but most people say they would have started younger. You can't say that. So what would you have done differently, even starting as young as you did?
Nothing, because even though I screwed up a lot early on, and even though I had some really, really tough times and made a lot of really big mistakes, every one of those difficulties, every one of those challenges, every one of those mistakes, every one of those failures, and every one of those successes made me who I am today. And so I'm happy with where I am today. So I would change nothing. Now it'd be natural for me to say, oh, well, I wouldn't have bought this property. I wouldn't have bought that. I wouldn't have financed that one that way, because then I wouldn't have lost that money and I wouldn't have, been in that difficulty. But you know what? It was that difficulty that made me think my way through. It was that money I lost that made me realize that, it's much easier to lose money than make money. So you have to be very careful. It's that kind of stuff. I wouldn't change a thing.
Wow. That's some wisdom, folks. You're like the Yoda of the real estate world. Not that you talk funny and reverse your sentences.
Right, real estate, I am.
You're just like, and there's some wisdom gold. Peace out. Great. Wow. Thank you, Brian.
Hey, thanks for the time, Brian. Is there, are you looking for anything? If people wanted to contact you, they're like, hey, I'm in this area or something, or how do they contact you? What are you looking for?
I'm not really looking for anything right now, but nevertheless, the best ways to find me are either through our company website, praxcap.com. It's praxcap.com. You can also find me on Instagram at Investor Brian Burke, or just check out the book, The Hands-Off Investor, which you can get on Amazon or direct from the publisher, biggerpockets.com/syndication book. And tell me what you think of it.
Awesome book. Highly recommend, whether you're thinking about investing or you are already an experienced investor. That was a very nice read that helped to get me and Vince to kind of narrow down like, oh, that's how it's done. So thank you for that, man. We really appreciate your time.
My pleasure. Thanks for having me on the show, guys.
Thanks, Brian.
I don't know about you, but I definitely like to see 5-star reviews on any service or any product before I purchase. Please take a second to leave us a 5-star review, whether you're listening to it on Apple, iTunes, or Spotify, or whatever platform. Take a second, goes a long way, helps us a lot to grow the channel, and thanks for listening.